Hello everyone and welcome to Markets Analyzers. In this video, we will learn about how does a small business model looks like, and I will also explain the level of safety you will have at different price points. The business will not change, but the price at which you buy a business will have a big say. I will try to keep this video as simple as I can so all the people who are watching it can understand easily. From small tea shops to big giants, big corporations, the principles of valuation apply across industries. By the end of the video, I want you to find the value of small business present around you. If you could do that, then this video would be considered successful. With introduction done, let's get into the video. Do like the video if you found this content informative at any point and share the video with your friends as well. First, what is a small business? For any business, whether small or big, there are three common things. First, the owner of the business. In this example, there is only one owner, whereas in stock market, if you buy a publicly traded company, there might be multiple owners. There might be thousands of owners to a single company. You might laugh at this, but this is where people will get confused. Always remember, if you buy a share of any company, then you are the owner of the company. People might think if they buy a share, then they are like the employee of the company. No, it's not true. You can be both the employee and the owner. But from an investor standpoint, if you own one share, then you are owner to the value of that one share in the company. I hope you are clear. Next, the business. Let's say the owner has a tea shop somewhere, maybe in a busy bus stand or in a railway station. Now the owner decides to not work in the tea shop. He hires a person to look after the shop and to manage the finances in the tea shop and to keep the tea shop clean. Cleaning the glasses, everything will be done by that only person he hired. As a owner, he will only get the money that the business made in that entire year. Not only for a small business, even if you buy shares of big corporation, that's what your job as an owner will be. To get the money the business made in a given period of time without you working in that company. The first part is the owner. The next thing is the business. And the third part is you got to have the customer. These three are common in any business, whether small or big. Now we have a basic structure of how a business looks. Let's now see how the money flows into that business. First, the customers. They go to the tea shop and they spend 100 rupees in the tea shop for 1 hour. This 100 rupees is the total money flown into the business in 1 hour. It is not for a year or a day. It is just for 1 hour period. This 100 rupees is called revenue. Will this 100 rupees directly go into the owner's pocket? No. To earn 100 rupees in an hour, the owner needs to spend some money. This brings us to the expenditures. This is the money that owner should definitely spend to make that 100. Let's say they are paying 20 rupees as a rent for that shop. If you remember, I said the shop is present in a busy bus stand or in a railway station somewhere. So the concerned authority will definitely collect the rent from the owner. The rent they are paying for 1 hour is, let's say, 20 rupees. Next, the employee cost. The owner has hired a person. He will do all the work in the tea shop. So the owner pays him maybe 30 rupees because he does multiple works. So he gets 30. Next, the cost of materials. To make a tea, they should buy milk, tea powder, cylinder to make fire, and cost to buy those teacups. Such expenditures comes around, let's say, total of 20 rupees. If you add all these three expenditures, it comes around 70 rupees per hour. The owner has made 100 rupees per hour. But to make that 100, he had to spend 70. Now if you take that 100 and subtract with 70, you will get 30. Let's say he does not pay any taxes. Then that 30 rupees is his profit for 1 hour. This is called net profit and it is also called as net income. This net income is the most important term in any business. This is the ultimate. Any business is done to get profits. So you need to keep a close eye on that term while valuing any business. Now as an owner, you have all the rights to do whatever you want with that 30 rupees. You can either transfer that 30 into your bank account or you can invest that 30 rupees back into the business, into your tea shop, which helps your business to grow and make even more money in an hour. Maybe he might buy a very good quality tea powder or he might spend on advertisements to attract more people, which might bring in more money into the business. Or as an owner, you can do both. You can take some part of that 30 rupees and pay yourself and invest remaining part into the business. That's what you will see in most of the cases. That money goes into two ways. The money which owner received is called dividend and the money which went into the business might be retained into equity. I will go into that in a bit, but in this entire scenario, net income is the most important number which you need to remember. Earlier you have seen money flown into the business for 1 hour. Now I have added few zeros. Let's say this is the money flown into the business for 1 year. Now the total revenue is 1 lakh. The cost or expenditure is 70,000. The rent for the entire year is 20,000, employee cost is 30,000 and materials cost is 20,000. I just added few zeros to all those numbers. If you add all these expenses, they add up to 70,000 rupees. Now the net income is 30,000 rupees. I hope you are clear with the business model, the flow of money through the business and how much the business makes in 1 year. As an investor, how much money you will be willing to pay for this business. The owner wants to sell his business. Let's say you will absolutely make 30,000 rupees every year. There is no threat to the business. The business is very, very stable. How much you will be willing to pay to buy this business? Before moving in, I want you to answer how much you will pay. Do a comment. Whether it's right or wrong, please do a comment. Also remember, you don't have to work even for a second. The employee will take care of everything. All you got to do is to take the 30,000 paycheck by the end of the year. So what's the company worth? If there are 10 different people analyzing the same business, the 10 people might say 10 different prices. Let's say you paid 1 lakh to buy this business, then the amount of return you would get is 30%. If you pay 2 lakhs, then your return will be reduced to 15%. Similarly, if you pay 5 lakhs, your return will be reduced to 6%. The business never changed, but the price at which you bought the business will determine the rate of return. If you buy at 1 lakh, your PE, price to earnings ratio, is at 3. If you buy at 2 lakhs, your PE is at 6.6. If you buy at 5 lakhs, your PE comes around 16. So lower the PE, higher the return. So this is why if you overpay for any business or stocks in general, the return you will get will decrease. Until now, we have spoke about how to estimate the worth of a business. Now let's try to understand the safety of our investment. How safe is our investment? The owner of the tea shop wants to sell his business and he sets a market price of 2 lakhs. How do you determine the safety of this investment? If you know, do a comment or else just continue the video. This is where the balance sheet comes into the picture. Income statement will provide total revenue and net income, whereas balance sheet will provide the total equity of a business. These two documents will be provided by all the companies to their shareholders, or you can find them in a click through internet. Type the company name and look for income statement and balance sheet. As we spoke earlier, income statement provides us with total revenue and net income. Balance sheet provides us with total equity of the company. If you don't know what equity means, let's say the company has been completely liquidated. It basically means right now we will end the business and we will sell all the assets that the business has. In our tea shop, maybe the tea glasses, maybe a fan that's present in the tea shop, everything that can be sold in the tea shop will be sold. And if the company or the tea shop, if it has any debt or loans, maybe they want to pay to the milk supplier, or if they have any money that is owed by them, we will pay them off. The remaining money is called equity. Your assets minus your liabilities is your equity. To even clearly understand what a balance sheet will try to tell us, try to make your own personal balance sheet. List out all your assets on one side, like your car, bike, your bank balance, your house, or anything that comes under your assets. List them all on one side. And on another side, list out all your liabilities. While listing your assets, give them a fair price. For example, if you bought a car for 10 lakhs 2 years back, now don't list the value of that car as 10 lakhs. Give it a fair price. The price for what you can sell the car right now. Maybe it could be around 8 lakhs or 7 lakhs. Give it a fair price. Keep this in mind for all your assets. Coming back to liabilities, it is the money that you owe to others. It might be loan on your house. You might have a personal loan. List all those liabilities on opposite side to assets. If you subtract assets minus liabilities, the number which comes is your worth. If you just disappear right now, that's what the people behind you will get. Now the same thing, let's look for our tea shop. First, total assets. Maybe the shop has a tea vending machine which is worth 10,000 rupees. Maybe they have a fan and air cooler which worth around 5,000 rupees. They might want to receive some funds from people. It comes around 5,000. Maybe they have some fancy cups to provide tea which cost 10,000, and they have cash bank balance of 20,000 rupees. So the total assets comes around 50,000 rupees. So it's the value of the assets present in that company, in the tea shop. Now let's talk about liabilities. It's the money that they are owed to others. Maybe the tea owner hasn't paid the salary yet, so the salary owed is around 5,000. If you observe here, fan and air coolers are mentioned in both assets and liabilities. In assets, its worth is mentioned at 5,000, whereas in liabilities, I have mentioned at 3,000. This is because they might have bought them with a loan. Its fair value might be 5,000, but they still have a loan of 3,000 on that. So That's why the fan and air cooler is mentioned in liabilities as well. Same for the cups. You might see the cups in assets which is worth 10,000 rupees, but they still have a loan on the cups which they need to pay off worth 8,000 rupees. So if you add all those liabilities, it comes around 16,000. If you subtract assets minus liabilities, the total equity is worth 34,000 rupees. This is what you will get if the companies just gets killed right now, if it gets liquidated. If the owner of this tea shop is unable to find a buyer, then the worth of the money the owner will get is 34,000 rupees. He has set a market price of 2 lakhs, but the equity value of the company is just around 34,000 rupees. The remaining 1.6 lakh is the risk that you have if you can't find a buyer for the business. Let's say you bought this business for 2 lakhs and after a few days you decided to sell the business. If you could not find any buyer for your business, then you will only get 34,000 rupees. This is the equity of the business. The closer the equity to the market price, the safer the investment. Let's say after 1 year, if you look at the business and its balance sheet, the equity might increase. Earlier we have spoken about net income, and the owner has the right to do whatever he wants with that income. Let's say he decided to invest the entire profit he got back into the business. So the 30,000, if he makes proper sound financial decisions, it might reflect in equity. Let's say he has paid off the salary completely. This 5,000 will disappear and he still has 25,000. And he decides to pay off the loans on both these 3,000 for fan and air coolers and 8,000 for those fancy cups. Now he has no liabilities. He doesn't owe a single rupee to anybody. After paying all his liabilities, which comes around 16,000, he still has 14,000 in cash out of his 30,000, which will be added into the business bank account. So now look at the total equity. It is increased to 64,000. He has no liabilities. He paid them off out of his 30,000 rupees. After paying his liabilities, the remaining amount is added to the corporate account, which is an additional 14,000 to the existing 20,000. Now the total equity is 64,000. Still, if you pay 2 lakhs for this business, if you liquidate, you will get only 64,000. So this is how things work. This is just a basic explanation of how a business valuation should take place. Try to find the businesses which gives you high rate of return with good safety. I hope you found this video informative. Hit the like button if you found this video informative and subscribe to our channel Markets Analyzers for more such videos. I will come back again with another interesting video. Until then, take care and have a great day.